Good afternoon. Welcome to a very special edition of MEED Live. Today we are doing an interview, exclusive interview with Roy Phillip, who is the Senior Executive Vice President and Group Chief Credit Officer of Mashreq Bank. Roy, good afternoon. Welcome to MEED Live. Thank you very much for joining us today.
Good afternoon, Richard. It's a pleasure to join and talk to you.
Thank you. Credit risk and credit analysis is an incredibly important part of banking sector operations, but never has it been more important than it is at the moment during the coronavirus crisis. How has COVID-19 affected business, the bank generally, but credit risk as a part of the bank's processes?
As you are aware, the health crisis driven economic downturn. We started off this year with a strong first quarter. Most of the businesses were doing very well, and then came the COVID crisis. In the late March, the crisis started and it rapidly spread across the globe. So in April and May, if you look, the entire emerging market and economies across the globe have got into a crisis situation. We are staring at a recessionary situation in almost every markets across the globe, particularly in emerging markets. And in GCC, the forecast is for a negative economic growth of about 3%. And in our main market of the Middle East, the fall in oil prices has compounded the risk factors. We have a double impact now. We have the health crisis driven downturn in various economic sectors, and we have the governments which are dependent on the oil revenue. They now face the low oil price situation, widening the fiscal deficits and need for raising more money to manage the fiscal deficits. So it's a twofold impact in Middle East. There are sectors which have been directly impacted, and there are sectors which are indirectly impacted. So banks particularly are grappling with two issues. One, as a result of the economic downturn, as always in an economic downturn, the impact is twofold. One is liquidity, the drying up of liquidity in the market, and the second one is the credit quality and the impact of credit risk on the entire businesses in the region. So, firstly, the liquidity was drying up fast as interest rate has hit a new low, and the investors are withdrawing from riskier markets into safer investments such as treasury bills. So that has created a liquidity crisis for the banks initially when the crisis downturn came in. However, the governments across the globe, including the GCC governments and the central banks, regulators have stepped in with enough measures to ease the liquidity. They have given opportunity for banks to pump in money, and at lower rate of interest. They have come with several avenues to ease up liquidity which banks have used. Liquidity has now gladly stabilized in this market, and now the crisis situation is evolving, and banks are, particularly as the credit market is becoming increasingly challenging, banks are working with the customers and businesses to manage the situation, help them drive out of this crisis and overcome this crisis as early as possible.
If I can just ask you on some of the specifics of what you said. So how does the liquidity crisis manifest itself in applications for borrowing? So have you seen a surge in companies and private individuals coming to the bank and saying we need to extend our credit facilities, or we need more credit? And secondly, how does it affect your analysis of the credit risk? So the fundamentals of a lot of companies' businesses have been changed. What sort of change in the number of applications have you had?
The liquidity crisis means the available liquidity you allocate to the most needy businesses and individuals who need the credit support. And also it works in two ways. One, the funds available for lending will be limited, plus the funds supposed to be repaid by the businesses and individuals during this period also will not happen. So two ways banks will have a liquidity issue. So as I mentioned earlier, regulators have come with liquidity lines. Banks have managed to raise money now, and the liquidity situation has now eased up somewhat in the Middle East at least. Banks are now having sufficient liquidity to lend. Now the issue is demand for credit is slowly slowing down because in a crisis situation, most of the businesses will scale back the expansion plan and the new projects which they were planning. So the demand is getting less, but the help they require is to tide over the current cash flow issues because their turnovers are dropped about 30-40% in the last 2 months. Cash flows are drying up and they need support from the financial institutions to defer their payment liabilities for next 2 to 3 months or 6 months until the market slowly picks up and come back to the old position.
So it's not an increase in demand for credit, but it is an increase in requests for support through this particular period. So using existing bank facilities to fill the holes where companies have not got the revenues coming in.
Credit for demand is happening in two ways. One, when the sales are delayed, for example, most of the shops are closed, most of the trade is slowed down, commodity prices have collapsed across, shipments have been delayed. So that impacts the customers in two ways. Their inventory holdings are going up, their procurements are delayed, their sales realizations are slowing down. All these requires financing from banks. The trade cycle is getting extended, and that means a payment, a loan which would have been easily repaid in 30 to 60 days now may take 90 days to 180 days. And that's the support which banks are extending in these markets. They're working with the customers. I think the banks have done a sterling job in this market in supporting the businesses. I do interact with a cross section of businesses, CFOs in the market, and I think the steps taken by UAE banks collectively through the UBF forum and have been commendable, and people are appreciating the support which banks are doing. We ourselves have done a portfolio review and extended wherever genuinely people need support. We have given across the business. We have done it across the retail portfolio as well, where people's salaries are delayed, salaries are being reduced, their repayment capacity is impacted. So we are fully empathizing with these individual borrowers and giving them time to work with us and pay as the market improves.
And you mentioned that the government had introduced financial support measures to support the banking sector, to enable the banking sector to provide liquidity for their customers. What does that support look like from the central bank? Is it additional funds put into bank reserves, or is it monetary easing with lowered interest rates? What exactly have the governments done?
Mashreq has played a very pivotal role in this crisis. As you know, our chairman is the chairman of the Bank Federation, UBF. And we have all contributed and interacted through the UBF to the central bank. And central bank has come out with a zero-cost funding of 50 billion dirhams for banks. And this is based on the extent to which banks can support the businesses and individual borrowers. If you have to defer their borrowings by 3 to 6 months, that entails a requirement for funding, and that funds are provided by central bank at zero cost. So we help the genuine customers on one side and avail that funding, where we have to, normally what we would have got repaid, we are not able to collect from them, which we will take now 6 months or more from these customers as businesses are constrained and cash flows are constrained. So we get the support for liquidity from the central bank. As I can recall, almost 40 billion is already availed, and as we speak, probably banks are fully availing the 50 billion support.
I wanted to ask you about which sectors were most vulnerable to long-term damage from this crisis? Is it the construction and the project sector because there's a slowdown in projects, or is it actually the consumer sectors where customer confidence is key?
The construction and contracting sector and the real estate sector, I will separate it bit, talk about it differently. Construction and contracting in the GCC is driven by the government investments. So the impact of low oil price is directly going to impact the construction and contracting sector, as GCC governments may slowly, their investments will slow down, and the new projects awards can also get delayed. Similarly, even payments can sometimes get delayed and contractors can have a liquidity issues. So it's twofold: fewer awards of contracts. Secondly, the slowness in the executing in the projects because of the COVID-related. This is a labor-intensive industry where labor camps, people are put in labor camps, where the impact of COVID would have impacted the workforce and the ability to execute the contracts on time. There is a temporary slowdown we are witnessing. And if the new projects are not coming, the industry will get impacted. And on the real estate side, there was already a slowdown happening because of oversupply, lack of demand and oversupply. So the real estate projects, some of the projects have been slowed down in the region, particularly in the UAE. Some are kept on hold. So there are positive actions taken by government in the last 6 to 12 months to support the real estate market. And at a time when the employment is falling, there is a wage cut and redundancy looming. This will have a profound impact on the real estate sector. And we again have to treat the hospitality differently. Dubai in particular and UAE is focused on travel and tourism. It's one of the major sectors supporting the industry in the economy. And the lack of travel and the slowness in tourists coming into the peak season. Now it's summer, it's not the peak season. Come October, the peak season is coming. By that time, if the economy recovers, hopefully the hospitality industry will show some ticking up. It is one of the worst impacted. The hotels are having very low occupancy, and they're trying now, slowly the revival is happening. Food and beverage, it's severely impacted. Restaurants, which is where Dubai is very popular for tourism, retailing and food and beverages restaurants. We have some really fantastic restaurants here. All are now closed or working at very low capacity, depending on takeaways and deliveries. So I think the time to recovery is very important in revival of some of these industries. And construction and real estate will not depend on the recovery of the oil price in particular.
And from your perspective, from a credit risk analysis perspective, how does that affect the way you view your customers? So for example, if one of your customers is a construction contractor, and you've just described, the risk to new projects from low oil prices and delayed payments. So how does that change the way you analyze the credit risk?
Correct. On the contracting side, we are working with customers as usual, in deferring some of their commitments. If they don't get paid on time and there is a delay, normal payment cycle is 90 days, and if now it's getting stretched because the project owner is delaying payments, then we have to correspondingly help them by supporting and extending their terms, which we are proactively supporting and working there. The second impact is a lesser amount of contract means their business capability and turnover will come down. Their revenue is going to come down. They have to go on working on more and more contracts and keep it running to maintain the workforce. So on a longer term, there is an impact. Their order book is shrinking. Then they will have to look at cost reductions, and similar to what happened in 2008-9, these two sectors were severely impacted. And there was a situation where employees labor force was sent back on 3 months, 6 months holidays, and then when the market picked up, they were called back to revive the work. So that kind of actions proactively has to be done. The good thing in the current crisis is all have learned from the 2008-9 crisis to manage the crisis better. Their business continuity plans are more robust nowadays, And banks and customers have the ability to now, who have learned from the lessons in the past, both 2008-9 crisis and the 2015 low oil price crisis, both are better prepared to manage it together. That's what we are trying to do.
So is it your view that this crisis is worse than the global financial crisis for this region in terms of its long-term impact? Is that your view? Is that this is a worse crisis?
Definitely. There's no comparison. In fact, the 2008-9 crisis was a financial crisis driven by the subprime lending in US and the related impact of the bond markets. It was mainly impacting the financial markets, and luckily in GCC at that time the oil price was averaging above 100, and the impact to some extent was muted in the GCC, as I recall, even though construction and contracting and real estate were two sectors which were severely impacted, and the banking sector. But in general, the impact was little better managed in GCC, particularly because of the oil revenue the governments were having at that time. This current crisis is something very unprecedented. It came all of a sudden. It was not anticipated to spread across the globe as fast as it happened. So somewhat people were caught by surprise. However, learning from the past, with 2008-9 also the regulators and governments had a big role in helping the economies to survive by pumping in funds and concessions into the market. And the same thing is happening this time. All the central banks across the globe, all the governments have been supporting the economies by liberal measures, by coming out with the liberal measures, and we are seeing it across GCC as well.
So I think what you are telling me is that the bank is comfortable to extend loan periods and to support its customers through the difficult period, and the central bank is behind you, but you will be more discerning on the strength of those customers. So for example, companies who are perhaps over leveraged may not get the support they require. Is that what you were saying?
So the guidances from regulators are very clear. While we have to proactively support the customers, we also have to maintain the credit quality and the credit standards, and that we will ensure. We will approach each customer with empathy and more flexibility and manage it. It will depend on the credit rating, quality of the customer, how we tailor the needs and what. We are working with everyone. We'll support. It's a time where they need support and we will do it. But the credit standards, there are cases where, for example, some customers would have had clean facilities earlier and lesser covenants and security. It's a time when both customer and bank may agree on better structures of lending, better covenants and security. It's a win-win situation for both. We can lend, they can avail the funds to tide over the crisis. In a very benign and booming market, probably both will be relaxed on terms. In a crisis situation, both have to agree on better structures and better covenant structures.
Is it going to be difficult for new customers to find access to capital, to credit?
Not at all. In any market, a new-to-bank customer is subject to a much more enhanced due diligence and robust risk analysis. We will, in these market conditions, we will do that exactly, look at the forward-looking approach, how this business, who are the sponsors, what's the future of this business, and make that judgment. How much of equity the shareholders are committing and how it is managed, their experience, all this will be factored into, and based on an enhanced due diligence, we will do. We have not stopped lending. No bank has stopped lending as far as I know. We are looking for opportunities. I think every crisis brings opportunities, and that's what we are looking out for.
Very good. In the financial crisis in 2009, 2010, we saw a lot of bad debt. People, particularly in this market, sort of maxing out on their credit cards and leaving with unpaid debts. And we saw a lot of corporate failures and even companies leaving the region, international companies leaving the region as well, particularly in the construction sector. What assumptions have you made for things like bad debt and non-performing loans, and those sort of things that affect the credit, the credit adequacy or the capital adequacy of a bank?
So we have undertaken various stress tests on our portfolio. We have also used IFRS 9 tools to assess the impact on the credit quality and the risk charge. We had a good start to the year. First quarter was good, but we do expect a slowdown, and we do expect some impact on the credit quality. That is invariable in this market because some of the small and medium-sized customers and all probably will get impacted more than others. Some sectors a little bit more. So after the deferral period is over, the way the bank's financial institution will work with the customers and how we will work together to tide over this crisis is very important. And all of us are geared up we are considering the drop in quality, how to manage. So based on stress testing, all of us are planning a more than budgeted risk charge this year, so that we can manage the overall balance sheet properly. And that is across the industry. That's the way it is going to happen in this crisis. So we are all geared up. We are taking proactive measures, remedial measures, and conservatively looking at our business plan this year.
One final question. One of the trends that was happening before the crisis was the digital transformation of many businesses, particularly the banking industry. Do you foresee some challenges around the digitalization in this market because of that sort of personal relationship culture?
I think one of the good takeaways of this crisis is the manner in which most of the industries will evolve in the future. Everybody has been impacted by the crisis because of social distancing and movement and work from home. So Mashreq has always been in the forefront of digitalization. And I'm glad to say, when the crisis started, 97% of my entire credit risk team are able to work from home. Only 3 of us are in the office today. All are working from home. It is business as usual for us. It has not made any difference for us as far as work is concerned. So Mashreq has been implementing digitalization. We are one of the top banks in digitalization in this region. We have invested heavily. Digitalization is the way forward, particularly in retail banking. Even on the credit risk management, we are looking at for all the tools of decision making. A lot of it will be driven by the data, which will be digitally driven, the customer behavior. All these will help us to make a much more considered judgment of credit decision in future. And digitalization is variable. And the new generation business, they understand. Most of them are happy to work in a digitalized environment. Our trade products are offered digitally, and a lot of our customers are using it, and they are benefiting it from that. It's quick, it's fast, and we are in the forefront.
Roy Phillip, Senior Executive Vice President and Group Chief Credit Officer for Mashreq Bank, thank you very much for your time.
Thank you very much, Richard, for this opportunity. Thank you very much.